So this is a video tutorial to how to record inventory into income statement. Before we get to that part, we get back to what we've learned in Unit 1. So in Unit 1, we've learned how to prepare an income statement for a service business where we don't actually have physical inventory in our business, we just have services. We provide services to customers to receive cash sales. And then we total all of the expenses that we have to spend during that period, which is 3,800. We take the revenue minus the expenses, we have the net profit. How to prepare the income statement for trading business is pretty much the same, except that we have to take into consideration the cost of us buying the inventory. So we have the exact same entries, which is revenue, cash sales, $10,000. But now we have to less the cost of sales, which is the total cost of the inventory that we have sold. So for example, in this period, we have sold 10 of the 120, let's just say, bag, for example. So we are selling bag. And we have two kinds of bags. One is at 170 each and one is at 150 each. So for that period, we've sold 10 of the 170 each. So we have the total of the total cost of the 10 bags that we have sold is at 1,700. We also have sold 2 of the 150 each. So the total value becomes 300. So the total cost of the 12 bags here that we have sold is $2,000, and the cost of those bags becomes cost of sales. So we have to take the revenue less cost of sales, $2,000. We have gross profit of $8,000. So gross profit is the revenue minus cost of sales. We have gross profit, and then we take the gross profit, we minus all of the other expenses, just like up here. So the total other expenses is 3,800. So we take 8,000, we minus 3,800, we have 4,200 as net profit. So remember, the gross profit here is different from net profit. So gross profit is revenue minus cost of sales, which is the cost to buy the inventory that have been sold down here. We have gross profit. Net profit is gross profit minus all of the other expenses. Okay, so that is how to record the inventory, the cost of inventory to income statement for trading business. Now we have learned about inventory loss and inventory gain before, so we just report as usual. We have cash sales, we have less cost of sales, we have gross profit. If we have a loss in inventory, we minus that inventory loss from the gross profit. Then we have the adjusted gross profit. So here we have gross profit of $5,000. We just found out that we have a loss in inventory of 180. So the adjusted gross profit would be 5,000 minus 180. We have 4,820. And all of the other expenses are pretty much the same. Okay, so we still use that adjusted gross profit. We minus the total other expenses, we have the net profit. If it's a gain, we do pretty much the same, except that instead of $5,000 minus 180 when it is a loss, for an inventory gain, we add them in. So $5,000 add 180, we have the adjusted gross profit as 5,180. Again, other expenses are the same, so we just take the adjusted gross profit minus the total of the other expenses, we have the net profit. Okay, so it's pretty much very much the same as income statement that we have learned in unit 1, but we add in the cost of sales, which is the cost of all of the inventory that we have sold during that period, and we add in inventory gain, or we less the inventory loss in order to have the adjusted gross profit. And then from there, we minus the other expenses, the total, then we have net profit. And then the second part of this chapter 18 is how to manage inventory so that we can have an effective and efficient control over the inventory. So we can either determine minimum and maximum quantities of the inventory so that we can organize enough space in our warehouse to store them. Rotate all inventory. That means that we always push the inventory that is not really well selling compared to other inventories. For example, if we want to sell a desk, the really ugly desks that have been sitting in the warehouse for like ages, then we can maybe promote that desk, give some discount on it, and then to get rid of it as soon as possible. So rotate all inventory. Monitor seasonal products means that we have to predict what season would have the what inventory would be best sellings in what season. For example, clothes. Winter clothes would be best selling in winter, for example. So we have to order more winter clothes in winter time so that we have more products to sell customers. Monitor technological advances. Either you can use social media, or you can use websites, or you can update your accounting record software in your computer system in order to keep update with the technological advances in the world, so that the accounting record becomes more accurate, more efficient. Complementary products. For example, a desk and a swivel chair might become complementary, especially during this pandemic where people tend to work from home. So, for example, you have ugly chairs but very nice desks, and you really want to get rid of those chairs. You can offer the customers, if you buy this desk, I can give you half price on the chairs, so that people would be motivated to buy more and buy more chairs from you, so that you can get rid of those ugly chairs as soon as possible. Promote business and products. Of course, the more you market your products, the more you market your business, the more people come in and buy more inventory, buy more stuff from you. Adequate security. This is especially very important, especially if you have displays of your inventory on the shelves where no one is supervising the customers. For example, Harvey Norman, customers can walk around and just pick and choose whatever they like, and they steal it, put it in their bag. All right. So with adequate security, you can prevent customers from stealing, and therefore the actual stock tag might match with whatever you're recording on the system. That helps with the accounting recording. React to changes in market. For example, during this pandemic, people tend to work from home more. So if you can predict the change in trends or change in needs of customers, you can predict that they're going to buy more desks, they're going to buy more laptops, going to buy more chairs, more mouse pad, keyboards, mic, camera for computers, for example. So if you can predict those changes, you can order those inventory in advance, so that when the need actually actualize in the pandemic, you can have available stocks to sell to customers. Okay, so we have to talk about inventory turnover too, but that is not relevant in the SAC, so we'll talk about it later. The exercises that you can do is exercise 1, 2, 3, and 4 in chapter 18.